Welcome to India Market Open. We're gearing up for trade this morning. Lots and lots of news to watch out for. Global cues are slightly muted, but Niraj, and the market is seeming like the bears might have a little more control on the street, not just locally, but globally as well.
Yeah. Consolidation. Maybe we preempted some of it, but very likely, as the implied open is suggesting, that we'll start off lower, Samina, and likely stay lower. But the global news flow, as you rightly said as well, is not necessarily very pretty.
No, it's not actually, and it's, I mean, we've talked about this. Jan historically usually is a weak month for not just Indian but global markets as well. And you're seeing that. You're seeing the bears coming in. The little bit of euphoria is now setting out. That's the implied Nifty indicating to a gap down. The last 2 days, remember, we've seen profit taking at higher levels, and that was literally what happened across the rest of the world as well. So if you look at what Wall Street did, Wall Street in overnight trade had a bit of a down day. It was a day of profit taking. Stocks like Apple sold off over 3% in trade, and that could be one factor why the Nasdaq actually declined 1.7%. The Dow and the S&P also going home with small cuts. Remember, it's earnings season around the corner for them as well, so there will be lots of activity and stock-specific trade that global markets will be tracking. Largely risk-off trade. The other asset class to track is the dollar index. We had gone down to levels of 100 odd only a few weeks ago when bulls were clearly in control of most risky assets. This morning, of course, the global index back above levels of 102, 102.17 on the dollar index is what we have. Crude as well remained flat, and that could largely be on back of the fact that the dollar index has picked up strength. Despite the pressure in the Red Sea, crude not reacting too negatively to that in terms of gains, and that, like I said, could be a dollar play happening. Across Asia, cues coming in from Wall Street are driving those markets as well. Remember, Japan remains closed. They don't come back to trade until Thursday, but which is tomorrow is when they'll come back to trade. But most of those Asian markets deep in the red. Hong Kong continuing its losses from last year. China not looking good either. South Korea, Singapore also trading with a negative bias. That's pretty much the picture, Niraj. It's not pretty, more or less on expected lines, I'd imagine, right? You've had such a solid 2023, a really great year end. Jan is subdued. You've got volumes that are only just coming back to the market, and I think most desks would be looking to book profits globally, I'd imagine.
Very likely. So just in terms of enumerating the news flow as well, the Asian stocks do face a cautious day because the risk rally seems to be waning a little bit. So that's part one. Remember, the other big development that has happened is that Maersk has gone ahead and said that they will hold the Red Sea shipping until further notice because the Houthi militant attacks have just moved higher and higher. So watch out for shipping companies and shipping rates out here. So that is one thing to keep in mind. And oil has held off its decline, by the way, with the risk-off tone countering this Red Sea flare-up, something that Samina was talking about. A couple of other interesting pieces that I thought. We've all been used to COVID vaccines. Interestingly, an expiring Pfizer COVID drug dose is going to cost Europe about $2.2 billion. So that is the interesting news flow that stood out. And from an India perspective, while we're talking about what's happening with Indigo and Air India, Akasa Air is now coming up, and Reuters has said that it is nearing an order for 150 Boeing jets as well. So that could be interesting. But the trade setup for the day, a consolidation / corrective move, I would reckon, is the way to put this. And that is underway after the one-way rally. But keep in mind, the reason why it doesn't look too bad is because right at the start of this pullback that we're talking about, the Nifty PCR is already sub 1. Usually a PCR higher 1.2. Remember, a day before expiry, the put-call ratio, the Nifty PCR was 1.43 or 1.44. It is now sub 1. So we've already come off a little bit. Sure, can we do more corrective moves? Very likely. I mean, GIFT Nifty tells you that. You don't need Samina or me to tell this to you, but very likely that we'll have a downtick today and maybe for a few more days, because the other sad part about what's happening is what's happening to the Bank Nifty. Now, it's been 3 consecutive days of a corrective move in the Bank Nifty, and the worrying part is that if Monday saw HDFC Bank drag the Bank Nifty lower, yesterday everything else but HDFC dragged the Bank Nifty lower. So it's an all-round participation, if you will. HDFC Bank, which has rallied a little bit, has still not corrected as much. This is yesterday's move, and thank you for pulling that up. You look at that. Everything else but HDFC Bank pulled the bank Nifty lower. So HDFC Bank technically hasn't participated except for that one off day on Monday. So the bank Nifty downtick is being led by all constituents, and there's a lower high, lower low formation out there, which is a bit worrying. But the beauty, and you know, I'm following Samina here because she's been harping about pharma for the last so many days. But the reason I bring up pharma today is because if you look at the OI build-up in the pharma stocks, yesterday's session, on a skittish day for the market, almost all pharmaceutical names saw significant long OI build-up. That happens when traders and smart traders or insti traders are confident that there is something up in the anvil, maybe in the results, maybe just in the sector rotation or otherwise. But pharmaceuticals certainly seems to be that one space that people need to watch out for because of what it has done on the trading front on a very skittish day for the market.
Indeed. Niraj, I'm just going to comment on what you said about Bank Nifty, and that is where the pressure is very, very obvious. But you know, I think what we saw yesterday was, while there was a little bit of recovery that played out on the street towards the last 15-20 minutes of trade, we recovered. We didn't close at the day's low point, but it was HDFC Bank. The stock was trading negative, but finally went home with some gains. So while those gains don't look very large when you look at that number on the screen, there was a little bit of staged recovery that was trying, or HDFC Bank was trying to do towards the last few minutes of trade. And that propelled Bank Nifty to some extent. Of course, it couldn't provide all the support Bank Nifty was seeking, but nevertheless did what it could. Bank Nifty options expiry today, so the weekly expiry is also on the cards in today's day of trade. That could be one more factor to watch out for. But all in all, it is looking like this profit booking could continue. But what I think Niraj will take heart from is that the range is a very narrow range, and that could be a little more comforting than you know, big moves and big ranges. The trend of higher tops and higher bottoms continues to be made, and that's, remember, not just what you're seeing on D Street. That's exactly what happened on the Dow and the S&P last night as well. Those markets went home with cuts, but they made an intraday high and, of course, eased off and saw some profit taking emerging. So, I mean, glass half full, glass half empty is anybody's guess. But for now, we don't need to be worried. This is healthy profit taking. Everyone's talked about the fact that a 5 to 10% cut is on the cards and required at this stage, because you don't want to get so frothy and expensive that the fall then becomes even more sharper, right? This is good. We've had a great December. We're going into an earnings season. Traders want to rebalance. They want to go in a little bit lighter positions. And that's what you usually would do as any other trader. The good news is FIs continue to buy into our market, and that is what we had in terms of flows. That's the number in front of you. Not massively large, but nevertheless worth a mention that the trend continues to be on the upside when FIs are buying into a country. But it is risk-off trade. Like we've said, the dollar index is higher. The rupee will open weaker today. You will see crude trading range bound. So despite the concerns on supply with whatever's happening on Red Sea crude not really reacting. But lots of counters to watch out for. I'll start with Avenue Supermart. Remember, that's the parent company of retail chain DMART. The provisional numbers did come in, and those numbers are more or less in line, I'd imagine. The standalone revenue came in at 13,247 crores, a 17.2% rise year on year. Store count has also gone up by 17 by 17 stores in the last 9 months. They've talked about a guidance of adding 23 more stores in the fourth quarter, questionable given the current pace of additions that the company has seen. Continue to see tepid quarter for same store sales and per square foot sales as well. Citi, of course, continues to maintain a sell call on Avenue Supermart. The stock in the last couple of years has faced stiff competition, remember, from retailers. It's pretty much flat in the last 1 year and down about 12% in the last 2 years. Do you have a tap on Avenue? Because the numbers, no matter what they do, the stock has been not really doing too well for whatever it's worth.
Yeah, last 2 years hasn't, but you know, it doesn't necessarily react negatively on bad numbers too. But Samina, you hit the nail on the head. Just one thing, just the update from Citi, the note as well, and they mention, and two important points. One, that the 17.2% revenue growth might look impressive, but the 4-year CAGR is 18.4%. At least some people, some analysts put it at 21% as well. But be that as it may, whichever the number may be, the revenue 3Q number doesn't look as impressive as the CAGR numbers. And the store count, you're so right. I mean, they've added 5 in quarter 3. even if they do whatever you're saying that they won't reach the target of 40. And therefore, even on the store count addition, most notes actually, Citi saying slower store growth disappointing. I think, if I'm not wrong, the Morgan Stanley note said the same thing. And one more note that I read said the same thing, that the store count addition from Avenue Supermarts seems to be a bit weak than what they have guided for, not just what the market estimates. So let's see how this stock does. It's not an FNO stock, unfortunately, so not too many people can take a short trade. It'll be interesting to see what happens.
See a little bit of pressure in the cash markets. Anyway, talking about Dr. D. Radhakrishnan Damani, let's talk about another company that he clearly is the majority single stakeholder, and that's VST Industries. Remember, they are a cigarette manufacturer. We saw a pretty large block deal on the counter yesterday. In the last hour, the stock shot up, managed to go home with gains of 20%. Damani has acquired 2.2 lakh shares of the company, which is about 1.44% of total outstanding shares in this block deal. Remember, he is the single largest stakeholder in VST Industries. From the shareholding data that we have, Brightstar Investments, which is an entity owned by Damani, holds 25.95%, and you've also got Derived Trading and Resorts, which owns 4.76%. Both these entities are owned by Radhakrishnan Damani. The other buyers in the deal were SBI Mutual Fund, which acquired 2.25 lakh shares. You had HDFC Mutual Fund, and that was the net seller. Interesting company again, Niraj, because they've lagged ITC in the recent quarters when it comes to volume growth. The stock itself has been a laggard, to say the least. So when you compare it to ITC, valuations are relatively attractive, but the run rate hasn't been as solid either on VST.
Yeah, you're right. I mean, and very few people have a handle on this one. The stock as well, I mean, the counter is not very liquid per se, but, you know, Samina, for all the misgivings that we may have about it, the man who's bought it, his name will just evoke the response, I guess.
I guess, yeah. And he is the majority single stakeholder in the company.
That too.
So you want to watch out for this one. Their earnings as well, they're trading at 15 times 25, while ITC is trading at 11% premium to that, so 26 times. Be interesting to see how the counter opens in today's day of trade. Quick one on Hero MotoCorp and Bank of Maharashtra. Hero MotoCorp reported numbers for December, and just like the rest of the pack, this one hasn't done too much either. Slightly disappointing in terms of what those numbers look like, but from Jan to December, so if you look at the preceding 12 months, it's actually been a pretty solid year for Hero MotoCorp. This month, in line with what the rest of the auto majors have done. Remember, we're seeing a high base effect on back of what we saw in the festive season, so expectations are running high, and none of these auto companies have kept up with those. But Niraj, that's what I have, but I guess a whole bunch of other names as well.
Yeah, so since we spoke about I'll save Adani for the last, okay? Let's do it that way. So since you spoke about VST, a couple of other names which saw some interesting buying. Strides Pharma Science. Now, Amansa Holdings has picked up 18 lakh shares worth 120. When Akash Prakash writes, or when Akash Prakash's company does a trade, people stand up and take notice. And I think there is merit in trying to study Strides Pharma Science a bit more. The fact that it's from this healthcare space adds to the luster. I would suspect that there could be more traction on this one today, purely because of the fact that Amansa's name has come into Strides Pharma Science. So watch out for Strides Pharma in the session today. Watch out for PDS, another very smart stock picker. Sumit Nagar, Malabar India Fund has bought 10 lakh shares, 0.76% stake at 505 apiece. The stock wasn't doing that well yesterday, but there were some bullies. Look at the volumes there, 2 million shares traded. So therefore, PDS could be in focus purely because of Sumit Nagar's name attached to this. So watch out for PDS in the session today. Watch out for Shah Metallics in the session today. They've launched the QIP. The base issue is about 152 crores. The indicative price, of course, is at a discount of 10% to the closing price, and the total dilution with the green shoe option is about 9.4%. Now, viewers, the simple point out here when it comes to Sham Metallics is that the stock hasn't rallied quite a bit because there's this constant overhang of a 6% stake that the promoter needs to bring down. Their stake, I think, is circa 81%. They need to bring it down to below 75 by June. And this was this constant overhang in Sham Metallics. Now that this deal or this QIP will possibly bring down that promoter holding below 75. It'll be back to business and back to business as usual for Shah Metallics. And the stock then will follow what the business prospects are. So it'll be interesting to hear from the management whether they stick to the earlier guidance of doing maybe 20-25% growth for the next 3-4 years. And if that happens, then the valuations are not very, very demanding for Shyam. So it'll be interesting to see if the stock opens at a wide discount or does it get bought into. Watch out for Shyam Metallics in the session today. Samina spoke about Bank of Maharashtra. A couple of other December updates or quarterly updates. Moil, the December update seemed strong. It recorded a production volume of 1.85 lakh MT, which is up about 31% YOY. So strong numbers there. Maybe Moil reacts. Maybe Rama Steel Tubes reacts. Q3 sales volume. QOQ was up 31%. Now, excuse me, I don't have the YOY number. That would have been the right way to look at it. But just the fact that the QOQ number is up 31% might also be strong. But, you know, QOQ might be deceptive because it comes off a monsoon quarter. So really, excuse us, I don't have that number of YOY, but it seems to be a stronger one. Last couple of things that I want to mention. One is the Adani Group stocks, and they will be in focus not at 9:15. Maybe they could be in focus at 9:15 as well, but at 10:30 or 11 or 11:30, the Supreme Court verdict on the Adani Hindenburg case will be out. Maybe a lot of the verdict will be around processes, around what SEBI has done, around short selling norms, etc., and not as much on the companies, but it will bring the stocks in focus today. Difficult to say what will happen right now. We don't want to preempt. Once the verdict is out, we might be able to get experts who might be able to better predict what this means for the stocks. But just keep these stocks in mind. They will be active today. At the end of the day today, all of us will be talking about what happened to the Adani Group stocks. I'm just laying it out at the beginning. Standard disclaimer, the Adani Group owns NDTV and you're watching NDTV Profit. And the last thing on the piece, Samina, okay, we have an exclusive as well. So let's shift to that maybe.
So very quickly, this is talking about banking. This is our exclusive news that we've just gotten this morning, and this stock will be in focus on back of this. Our sources tell us that 800 crore credit card loans in stressed asset transaction will be sold. The transaction comes at a 97% discount to gross value. Portfolio consists of 2 to 3-year-old NPAs which were fully written off. Transaction aimed at cleaning up the retail loan book. Remember, RBL's gross NPAs as of 30th of September stood at 2,441 crores, where credit card NPAs were at 462 crores. So at a 462 crore number, Niraj, if they're able to sell that, I think it's significant to say the least, given that there has been a write-off over there. That money will come back and reflect on the balance sheet. An immediate positive trigger. I don't know whether the discount at 97% is good enough, or whether the industry standards are higher. I would not know. I don't know if you have any clarity on that.
No clarity there. I mean, it would be great to get Vishy at some point of time and understand from him these details of the granularity that you spoke about, Samina.
But I definitely think this is stock positive, so the counter will react positively to that. Remember, the RBL has said that this was fully written off. So this is 2 to 3 NPAs. RBL Bank had written this off. 97% of 800 odd crores is, of course, come back on the balance sheet, and that would be a huge trigger for the bank. Staying with banking, Niraj, we talked about Bank of Maharashtra. What we didn't talk about is Yes Bank and Punjab National Bank. PNB has registered 11.1% YOY growth in their global business for the quarter ended December FY24. Their global, of course, this is a provision number coming into the global business, and the global deposits, I believe, have increased 9.4% to 13.23 lakh crores. Advances are also up about 13.5%. So banks yesterday were, of course, putting pressure on the markets. Today, we've got a bunch of positive news flow. I mean, if you're a bull on the street, you'd hope that this news flow is taken in well and banks might come back with leadership for the Nifty.
Yeah, let's see. Smaller names. Would be interesting to see what their impact would be. Interesting to see this RBL news on the credit card piece as well, and wonder if that has any impact on the partners with which RBL Bank has had this credit card portfolio. I think we'll be able to throw more light on that once Vishy or anybody from our banking bureau who's broken this story would be in. But I think it's about time that we shift focus from the trade setup onto the editor's cut. And it's an interesting one today because we're talking about, resurgence in a couple of pockets, Alex, and questioning some of that.
Yes, absolutely. In fact, you hit the nail on the head, Niraj. On the editor's cut today, we've got two distinct topics. One is a sector and an index that has gained over 16% since the start of November, and in that time the Nifty 50 has gained about 14%. So it has outperformed the benchmark, and all through FY24 so far, you've had analysts, you've had investors write off the sector. This is of course the IT sector that we're talking about. In just about 10 days from now, it's going to be in focus on the back of earnings. So the question that we're asking is whether or not some of this is running ahead of the pack, and whether or not some of that pain in earnings that a lot of people have said will continue through FY24 will lead to a little bit of a drag for some of these stocks. We'll give you some of the insights that you need to bear in mind in the next 10 days. The other is a stock that is over 5 lakh crore in market capitalization, which is a much smaller free float. And some of the uptick in the stock is because the government has come out and said that the timeline for this company to reduce it or to increase its public shareholding is going to be pushed quite significantly. This is a stock that is played catch up with the rest of the industry as well. Life Insurance Corporation of India, if you look at the 1 year gains, it is now ahead of SBI Life as well as HDFC Life, and that's saying something for a stock that is yet to hit its issue price. We're talking about whether or not that relief rally, if you can call it that, is a little overdone. But let's start with the IT space. Tushar is going to take us through some of the key aspects to focus on. Tushar?
Good morning, Alex. Good morning, gentlemen. So, as you pointed out, IT pack has been it's painful in the last 1 year. What I believe, it's not going to dissipate anytime soon in the next 1 year as well, given the fact that we're going into Q3 earnings right away in about the next 10 days. So, let's talk about first about Q3. So more of the pain is going to persist in for this particular quarter, because October to December is a seasonally weak quarter for the IT pack because of furloughs and fewer working days for our Indian IT companies. Secondly, Accenture has already guided for about 1% sequential growth for its quarter, that is December to February, which effectively means that we are looking at pain for the Indian IT companies as well. Accenture added 10,000 employees in its first quarter. That is the quarter ended 30th November. We will not be adding, Indian IT companies will not be adding more because they're already flush with staff that they acquired during the pandemic. So essentially, we are looking at more of the same pain that we have seen so far in 2023. 2024 will be an entirely, what I believe or what I have understood from analysts is that 2024, the whole calendar year itself will be weak for IT companies. Again, let's take pointers or cues from what Accenture said in its latest earnings. It said that for its fiscal from ending August 31, it follows a September to August fiscal. They're looking at a growth of 2 to 5%.
And they've reduced it?
No, it's static, which is again a plus, sort of a plus. I'll just come to that a bit. It's about 2 to 5%, what they're saying, which essentially means that we are not going to look at the kind of numbers that we saw from IT companies in the last 2 or 3 years of the pandemic. So essentially a muted, a lackluster year, no fireworks as to what we maybe expect from a TCS, of which, for example, at this time last year, they had said they were looking at double-digit growth in FY24. That did not happen. That changed immediately after the first quarter results of FY24. What we are looking at is, again, mid-single-digit growth numbers for the Indian IT pack, going by Accenture's numbers. We see a margin expansion, what Citi said yesterday. We are looking at a margin expansion of about 50 basis points. Again, no margin levers left. We have exhausted delayed wage hikes. We are not hiring people. There is a reduction in headcount, so there is some leeway there to maintain their profitability at those numbers. But beyond that, I don't think so they can do it.
So the question is, why are we seeing such a big run-up? And maybe Niraj can weigh in on that in some of the conversations that he's had as well. On the valuations front, right? Because we've seen sectors and stocks run ahead of time. And we said, I think, mid last year, 2023, that the pain on the fundamental side is not over for the IT companies, but maybe the bottom on prices has been hit. That kind of played out.
But the stocks have rallied a bit as well, right, in anticipation of that. So in some sense, Tushar is preaching to the choir, right? Because one would presume that fundamentally things are not definitely going to improve. The antidote, maybe just one more point, just to Tushar's point, is that the antidote might be global in nature as well.
Yes.
If rates come off, and in some fashion, that is a big plus for metals, for IT per se? And could that help the overall sentiment on the IT pack, which hasn't quite gone anywhere?
And I think absolutely, you're absolutely right that that is a key trigger that can happen. So if there is, we don't see any more rate hikes by the Fed,
which is a given.
Which is a given actually. And if there are 3 rate cuts as what the market is pricing at this point of time, we are looking at a lift off by these companies by say June or July by this year. Second, we have to also realize that we are talking about the fact that things are not going to deteriorate from here on. That's what investors are likely pricing in.
The worst is over.
So what they're saying is, what we'll see for the entire year, 2024, is more of the same, which is good news. It's not going to worsen. That's what is rallying the stocks right now.
Yeah, well, this could be interesting. The last point, just one quick point here. Yeah. Everybody's factoring in 3. We had Manish Dangi yesterday saying that what if there is more? What if we actually don't have, I mean, it's usually negative for equities, but what if it's not a soft landing but a hard landing and the US Fed does a lot more in terms of rate cuts? Could that actually spur it even more? Could we have an earlier rate cut than June? And could the markets with discounts events like 3-6 months before they actually happen bring about further triggers? But this is interesting data from Tushar.
No, certainly, absolutely. And in fact, the second topic is no less interesting, because if you pull up the chart, the price chart for LIC, and you see from the 23rd of November or thereabouts, the stock has gained about 36%. Now, some of that, of course, has to do with the government's announcement about the pushing forward of the public shareholding. What else is playing?
Well, yes, so a couple of things since have played out, Alex, and good morning, everyone. The first thing that's essentially played out is the fact that we've seen LIC consistently deliver on the VNB margin front. The guidance during listing in 2022, when VNB margins were 9-ish%, was that we'll take VNB margins to 15 to 16%. Now, at that point of time, when I was tracking it, it looked unrealistic. To take VNB margins of such a large enterprise from 9% to 16% would take a lot out of the company. Whereas they've managed to do that.
In the second quarter.
They're in that 15% bracket over the last 2-3 quarters consistently, which essentially says that whatever the guidance that LIC is really pushing for, they are able to meet some of those guidances, especially on the profitability front, because VNB margins indicate profitability. So that's point number 1. Point number 2 is that in any case, life insurers, since the month of March, since the budget, were quite beaten. So we saw LIC, if we can have the chart from March on, LIC has actually rallied 60% since March of 2023, since the budget announcement, since the bottom in March. So from 530, the stock has essentially gone to 860 odd and come off to 840 where it currently sits at, which is a very, very solid rally, especially coming from a PSU. And therefore, the question begs, were valuations really, really steeply cheap? And that's where, if we look at the price to embedded value, which is how you typically value life insurers, it was at 0.5 times. When I'm looking at other peers, you have the likes of an HDFC Life at almost 3.5 times. You have the likes of an ICICI Pru 2 times, and you have the likes of an SBI Life 2.7, 2.8 times. And therefore, this valuation catch-up, it's still not even 1 time.
Yeah, it's still 0.8.
It's still 0.8 today as we stand. And therefore, it's a bit of a valuation catch-up as well. So it's a combination of factors, Alex, which is playing out.
So, but then the question is, with that kind of a run-up, a lot of people, that have held from the start will say, look, it's still an underperformer in my portfolio. But those people that manage to get at the bottom will say, look, is there a significant upside from this point on the business side? They've, like you've said, they've expanded their margins to this point, but there's a lot more that's playing, right? One of those is the move away from traditional business. How much of an impact could that have in the near term?
Yeah, absolutely, Alex. So you've hit the nail in the head. Despite all of this, LIC still continues to lose market share. Yeah. And consistently lose market share.
Exactly.
And that is set to continue. When I'm listening to commentary from other life insurers, largely the commentary seems to be coming that we're confident that we'll grow at a significant delta versus what the market is growing at, which means that they will outstrip growth of market, which means that they will acquire market share, which means that LIC will lose market share, right? It's a +1, -1. And therefore, that commentary seems to be intact. The other thing is LIC is a very, very large war machine. And therefore, growth will always be a challenge at double digit. But at the same time, they've guided for double digit new business premium growth for the current year. When the first half, they've grown just at 2.5% on new business premium. And therefore, they're expecting a very strong second half. So it's
which is normally the case for the LIC, for life insurance.
Which is the other reason why the stock has rallied as well. But it continues to lose market share. It's a typical PSU. It operates as one. And it's a lender of last resort. Whenever the government needs it, it does provide funds as and when required in whatever space that actually requires funding, Niraj. So,
Niraj, any last thoughts? The argument has been made for public sector banks for LIC.
Yeah,
Does
so
it still
similar
hold?
vein, right? PSU index has rallied so much, so no surprise that LIC, being a large PSU player out there, has rallied. PSU insurers, I mean, it's not just LIC, GIC, RE, or any of those others, right? They've not created wealth since the listing. So about time that they do. The only question that, and as Harsh pointed out, that while they are picking their act up, it's not that private insurers are sitting by the wayside. They are doing this. And as a retail investor, you don't need to have an insurance stock in your portfolio because you're not matching it to the index. If you don't understand the business, leave it alone. Look at other sectors.
Absolutely. And on that note, that brings us to the... Oh, you want to make a point?
One last point, Alex, and one very critical point here, which I missed making. Typically, your public shareholding has to be 26% as per SEBI norms. LIC's public holding is just 3.5%.
But they've got the leeway now.
They've got leeway,
for 10 years.
But that 20% is huge. What the government essentially needs to divest is roughly 1 lakh crore, which is massive. It took a lot for them to divest 21,000 crore, let alone a lakh crore.
So the government is invested in getting those. And very last point, only 5 of the 19 analysts that are tracking this company, that are tracked by Bloomberg, still have a target price that has not been hit. So bear that in mind on Life Insurance Corporation of India. Lots more lined up in just a bit. Do stay tuned. This is NDTV Profit.
Back with India Market Open right here on NDTV Profit. The headlines at this hour. The US markets are off to a negative start in the new year. Nasdaq lost over 1%, its worst fall since October. Meanwhile, back home, the Nifty and Sensex lost more ground. Banking and IT stocks dragged the indices yesterday. Oil prices have settled lower as supply concerns ease following easing Red Sea tensions, or despite them actually. Truckers call off strike. The disputed penalty clause will not be implemented for now, assures the Home Ministry. And the Adani Group stocks will be in focus ahead of the crucial judgment in the Adani Hindenburg short-selling case. So those are the top headlines, but it's interesting action on the derivative side. Agam is hereby to analyze that. Agam, good morning. What have you spotted and what is to be kept in mind today?
Right. Niraj, we're certainly looking at a pause in that big up move, and we saw that at least in the session the day before, because that is when we in fact saw the Nifty close, or not close, pardon me, well, move to life highs, and from there on we saw a correction. As far as yesterday's day of trade is concerned, well, we are looking at a little bit more weakness and a lot of longs unwinding coming through, indicated by a 6% decline in open interest. When it comes to the Bank Nifty, on the other hand, we're looking at fresh shorts. A 1% dip, a lot of that precipitation coming through just in the last 1 hour of trade, and with an 11% increase in open interest towards selling coming through as far as the Bank Nifty is concerned. Bank Nifty will also be in focus today because of the weekly options expiry. I'll talk about that in just a bit, but let's talk about the option space as far as the Nifty goes. In terms of changes, as one might expect, a little more writing around 21,200, 21,300, but remember, activity has now shifted lower. In general, that's as far as puts go, and on the higher end, on the call side too, the writing has now come down to around 21,700, 21,800. Instead of writing seen at the 22,000 mark. Then that will give you a range as well, which is shifted lower by around 200 odd points. Now your max OI stands at around 21,800 call and the 21,500 put. That's a 300 point odd range. And in terms of the Bank Nifty, of course, which will also be in focus today because of the weekly options expiry, we are now starting to see more and more writing around 48,000 mark. It's very unlikely, highly improbable that the Bank Nifty will be closing anywhere close to 48,000 should we see a weak opening today. And on the lower end, of course, we're keeping an eye on 47,500. And we're not too far away from there. It's a wait and watch. And talking about stocks, of course, it was a mixture of trade where the advanced decline ratio did move into the red towards the second half of the session. Still, we did see shorts in Bata and Aisha. On the other hand, longs in Delta Corp, Abbott and Tata Consumer. And on the other hand, in terms of unwinding, about a short covering for ACC and Siemens. But besides that, longs unwinding coming through for Dixon Tech, Balrampur Chini and LIC Housing Finance. The question really is that what do we do as far as the markets are concerned, especially when we are in fact expecting some amount of weakness. Let's get in Jay Patel of Investmentor Securities, who's going to give us an idea about how to deal with this. Jay, good morning and thanks for joining in. Let's start with your view on the benchmarks. I believe you also have a strategy to play out for on an intraday basis today on the Bank Nifty.
So good morning, Agam, and good morning, everyone. So today's, I believe Bank Nifty and Nifty, they're gonna start with a gap down opening, definitely because of global cues, particularly Nifty. If we saw yesterday, it has fallen to around 21,560, and thereby we saw buying coming in it at that level. So definitely 21,500 will be a support today we can look for. Also, 200-day exponential moving average is placed at 21,550 zones for a 15-minute chart. So definitely there would be a crucial point at that level, 21,500, and if it falls below that, we can see 21,450 levels to coming to be in for Nifty. Particularly for Bank Nifty, the chart is very interesting because yesterday we saw a short build-up, particularly the OI went up by 12%. And in Bank Nifty, if we are looking for a down move, I believe 21-day exponential moving average would be something we can look as a support, particularly at current price. 47,300 would be the zones where we can find a support for Bank Nifty. So I believe Bank Nifty, we can see a gap down opening, and obviously there would be a 300 to 400 points fall on Bank Nifty. And my strategy is lined up with buying a put option for Bank Nifty. So my strategy would be buy put option for 47,700 strike price put option at 212. We can see a target price of 350 coming in. and we can put a stop loss at around 124 zones. So Bank Nifty, I'm very bearish for today's session. Also, there is another strategy for Metropolis Healthcare. I believe Metropolis...
Jay, excuse me. I'll come to Metropolis in just a bit. Let me just very quickly address what's happening with the Bank Nifty, because as you've said that there has been a lot of weakness coming through. And we must remember, then viewers must remember that max OI, at least in terms of today's day of trade and today's expiry, in terms of puts, is at around 47,500. So should we in fact see that level break? And as Jay is mentioning, that if we do in fact see an opening of below by around 300, 400 points, that correction could come in. Well, you will start seeing unwinding around 47,500. And it will not just be in the option space. It will also, you also start seeing that precipitation as far as futures are concerned. You probably could see a lot of selling in the cash markets too. And hence that level becomes particularly important, which is why, of course, Jay is looking to take advantage of that sharp rise in gamma. And hence, you would in fact see a substantial increase in the premiums for the call that Jay is making. That is, of course, buying that specific put. Yes, so that's as far as the Bank Nifty is concerned, Jay. I believe you also have a view on Metropolis that you were just about to explain to us. If you could take us through that strategy as well.
So definitely, if we look at Metropolis Healthcare chart, so there has been the stock has been sustaining 200-day exponential moving average since past 2-3 days, also past 1 week. Particularly, if we see in a weekly chart, the stock has moved above that level, and you can see higher high low pattern coming in this stock. So I suggest to buy a bull put strategy on Metropolis Healthcare for January's expiry. So for this strategy, we need to buy 1700 put option at 64.35 rupees, and we can sell simultaneously. We can sell 1760 put option at 106 levels. So the maximum profit would be premium received, that is 16,580 rupees, and the maximum loss we can keep at around 7,400. So the risk reward ratio is quite favorable, and the maximum drawdown can be 30% and maximum upside can be 70%. So I prefer risk reward ratio is quite favorable, and I believe the stock can rise to upward level towards 1750 zone. So for January's expiry, I believe Metropolis Healthcare can be a good bet, and we can see probability of around 55% for this recommendation.
All right, so that's the strategy coming on Metropolis. What we're looking at is a potential for Metropolis to go higher and in fact hit levels of around 1715, which is why Jay is implementing this bull put strategy. Of course, this requires buying and selling the same instrument, that is the put in this case, in order to go ahead and take advantage of the up move that can potentially be seen as far as Metropolis is concerned. Well, on that note, Jay, we're going to take a moment to thank you for taking us through your views on the markets and also giving us that trading idea as far as Metropolis is concerned. And with that, it's back to you, Samina.
Thank you for that. Agam, that's of course all the action in the F&O space and a few stock picks coming from Jay as well. Bank Nifty is what we're going to be eyeing in today's day of trade. Very unlikely you're getting an expiry above 48,000. Implied opening is expected to be slightly lower, so you are expecting another down day, keeping in line with the global cues and overnight cues as well. So profit taking could still dominate today's day of trade. A quick update on that RBL point that we took you through just a few minutes ago. I want to bring in an update. RBL was, remember, looking to clean up its books after a change of guard. The stock has gone up 51% in the last 1 year. It's up about 16% in the last 1 month. And remember, the credit card repayment delays accounted for 1/5 of RBL's total gross non-performing assets. So this news would be welcome news point. And they have, I believe, if sources say that about 800 crores of credit card debt is now being bought out by Kotak Mahindra Bank. So it'll be good to see how both these counters actually react in today's day of trade. Along with that, a bunch of stocks that caught our attention yesterday and will be on the watch list today on back of bulk deals. Mahima is joining us with a whole list of those. Mahima, stocks like VST on the radar today again.
Right, Samina. So VST Industries, there was a bulk deal that took place yesterday. The combined transaction value stands at 151.84 crores. The sellers were DSP Mutual Fund and HDFC Mutual Fund, where DSP sold a stake of 1.61% and HDFC sold a stake of 1.29%. This was bought by RK Damani. He already holds a stake of approximately 30.7%, and additionally he acquired 1.4% stake yesterday. Also, SBI Mutual Fund also bought 1.45% stake in VST Industries yesterday. If we talk about the valuation of the company is currently trading at a PE of 19.86, and if we talk about the stock performance, the stock had hit an upper circuit at 20% yesterday, and it hit a 52-week high at 4,065 rupees. The next stock is Strides Pharma, where another bulk deal took place, where Amansa Holding bought 18.17 lakh shares, that is approximately 2%, at 659 rupees, and there were no particular sellers as such, but if we talk about the key shareholders, the promoters hold approximately 27%, Quant Mutual Fund and Aditya Birla approximately hold 5%, and LIC and Route 1 Offshore again hold over 4%. Then the last stock where again a large bulk deal took place was PDS, where Malabar India Fund bought 10 lakh shares, which is approximately 0.76% at rupees 505. The valuation of PDS currently it is trading at a PE of 47.05, and if we talk about the key shareholders, promoters are the major key shareholders here. They hold approximately 66%, and then we have Mukul Aggarwal, who already holds 2.72%, and Vallabh Bansali and Enam also holds over and above 1%. So this is the overall summary of bulk deals that took place yesterday.
Right, thanks for that. That, of course, is a whole bunch of stocks that will be in focus on back of block deals. We'll quickly move on. There are lots of counters that we will want to focus on today. The Adani pack being one such block to also be the talking point. And before I go over for the other stocks in news, Niraj, this is going to be the big talking point across market participants and Adani stocks.
Yeah, well, difficult to preempt, really.
Yeah.
But suffice to say that the interest on those stocks is anyways very high, and it'll be interesting to see what happens post the verdict. But frankly, difficult to preempt anything in regards to this. Let's wait for the verdict, and then we try and get the best voices to advise everybody.
To break it down for everybody.
But
indeed, on the radar of traders, and it has been really, even in yesterday's day of trade, Adani Port over the last hour saw enough and more activity. The stock went home at the day's high point as well. Of course, that was on back of the port numbers that came in,
and
which
also
are
the fundraise meet today.
And the fundraise meet, and now, of course, reports on the Adani Harinburg case that we had awaited. Talking about stocks and more stocks, Hindustan Zinc, MOIL and Avenue Supermart will also be in focus. Harsh is standing by with more on that. Harsh, numbers for Avenue Supermart may be a little disappointing for some of the bigger brokerages, but break it down for us. Same-store sales below expectations. I believe the likes of Citi actually have a sell call on Avenue Supermart. Harsh, I think we've lost you. We'll come back to you in a second. So
it looks very interesting, right? When somebody's talking all of this and there is no voice coming out.
Yeah, it's and unless you're watching us on mute, then there is no difference. But we'll go back to Harsh in a minute. But Akshay Bhagwat, Senior VP of JM Financial Services, is joining us. Akshay, morning. Happy New Year. And to begin with, this year has started off on a bit of a subdued note. The bears might have gripped a little bit of control on the street. We are seeing profit taking at higher levels, and Bank Nifty has been declining quite sharply. But on the flip, we've been making new highs and new lows on intraday basis over the last 3 days. The PCR ratio is sub 1%. VIX hasn't jumped too substantially either. How are you reading into these two very contradictory data points when you're taking a trade on the Nifty?
Good morning and Happy New Year to you and your team. Well, firstly, on the Nifty index, look, the charts are a bit overstretched for comfort where currently the Nifty trades. Even the fact that January month is historically known for the fact that it is a month which gives you negative returns on a month-on-month comparative basis. So these things are playing in the traders' minds. So what I understand is that the market is in a space where it needs to take a breather. Things have happened too fast and too soon. And the way I see the Nifty index right now, it needs a small time correction before sanity gets back in the market. So I would be taking trading here as the day goes. I will go by the live by the day concept here, or at the most limit myself to BTST trades, because the chances of the index jerking at any given point of time looks very high at the point where Nifty and the Bank Nifty trades. So for the levels for me is that the support of 21,500, where significant put writing in the derivative space is seen, that would be a trading support. And even if the market were to make a new swing high and get near 22,000, still I would not be very much comfortable to go aggressively long in the index. There are negative divergence signals on the technical parameters, and there's a good chance that the index should take a breather soon. So I will keep a wait and watch approach if I'm an investor. Trading, yes, stock specific approach is what continues, because the momentum in stocks is still there to be chased.
Now we also have Mayuresh Joshi, Head Equity Research India, William O'Neill joining in. Mayuresh, morning. Thanks for joining in. Happy New Year. Mayuresh, how are you feeling about the markets? We've had such a solid 2023. It looks a little expensive, looks a little frothy when you look at the broader markets. And of course, the joke in the pack right now is crude and earnings. Keeping those two very important triggers in mind, and the fact that there is a little bit of a risk of trade playing out globally as well, what would your strategy be on the markets at this stage?
Morning, Samina. First of all, wishing you, Niraj, the entire team at NDTV, and all the viewers of NDTV a very happy, healthy, wealthy, and a prosperous 2024. What you probably flagged off in terms of the risks that the market face, crude probably remains one of the outside risks, and what probably happens to earnings. So where we are at this juncture, earnings is something that will put a leg up for the markets. If earnings sustain for this quarter, if management commentaries around a lot of sectors, specifically around the banking and financial services across the consumption sectors, remain extremely strong and robust. My take is that the market will take cues from that for the next leg up. But there has to be a period of cooling off because what you're probably seeing in the broader markets is an unprecedented rally. A lot of stocks within the broader markets are at stratospheric valuations as we speak at this juncture. And therefore, there has to be a logical pullback as far as the broader markets are concerned. And from a risk-reward perspective, the large caps probably are offering a better margin of safety as we speak at this juncture. So we are being very, very selective. Structurally, the India story continues from both a macro and a micro perspective as far as the rest of the globe is concerned. But global cues, global factors, geopolitical risks might pull the markets down, which is again very, very healthy if you probably need to have a good push up again in the next few months. But structurally, I think nothing wrong with the markets, but being very, very selective as far as sectors and stocks are concerned.
Fundamentally, Mayuresh, of course, feels comfortable with the markets. But we'll talk about the various aspects of the market with Akshay and Mayuresh in a minute. But let's quickly go over to Harsh. Remember, we were trying to understand from him the provision numbers from Avenue Supermart, Hindustan Zinc, and MOIL. Harsh, take it from there. We didn't hear you because you're on mute, I believe. But what is the update on these three counters and why will they be in focus today?
Well, yes, Samina, so I'll kickstart this with Hindustan Zinc. We saw okay set from Hindustan Zinc, mine metal production at 2.7 lakh tons, up 7% year over year. Mind you, these are Q3 numbers which I'm flagging off. Refined metal production at 2.6 lakh tons, which is 1% higher year over year. And you have silver integrated output at 197 tons, which is up 22% year over year. MOIL having a better December. Let me flag the numbers there. December production at 1.85 lakh metric tons, which is up 31% year over year. You also have April to December sales come in at 11 lakh metric tons, which is up 40% year over year. So a couple of positives coming in. You're looking at Avenue Supermarts, whose standalone revenue stands at 13,247 crore, which is 17.2% jump year over year. Again, the number of stores stands at 341, which is just 5 stores added in this quarter and 17 stores added in this year, which is well short of the 40 stores expected to be added in FY24. Of course, have to wait and watch whether that can be met, but it's a tall ask. And what Citi seems to have done is summarized it very well. What they're suggesting is that the 4-year CAGR for the per square foot sale which Avenue Supermart makes is negative 2.5 odd %, which clearly reflects the kind of drag that the business is seeing. Also, what they're suggesting is that the lower end of value products is what is really selling, which is where the challenge for Avenue Supermarts currently seems to be. That needs to take a shift. They have a sell call on Avenue Supermarts with a target price of 3,100. They're cautionary on valuations, and what they're suggesting is that the business still needs a little bit of fillip to turn around.
Okay, well, those are some stocks to watch, and we'll talk to our experts about that. Thanks, Harsh. We'll need to slip into a quick break. On the other side of the break, we'll talk about all the newsmakers that need to be discussed. The ones with the bulk deals, the ones with the quarterly updates, the ones which will be in news a bit later on in the day. Coming up, stay tuned.
Welcome back to India Market Open. 3 minutes to go as we gear up for pre-open trade. Akshay, as we're gearing up this morning, there'll be lots of stocks in focus, but let's start with your top stocks.
Yes. So both the recommendations I have for trading are on the buy side because, as I mentioned in my opening remarks, it's still a momentum-driven rally and the momentum is still there to be chased. So the first stock which I would recommend here is from the pharma space. It is Syngene. And if you look at the chart pattern yesterday, there was a strong buying action in the futures and options segment. Even the pharma stocks have been on a roll lately. Last couple of days, they have seen strong long additions, long build up in most of the pharma names, and Syngene is no exception. At the levels of 721, these stocks seem to be headed for 750 plus targets in the short term. So I would recommend to buy Syngene at the current rates for targets of 750 plus with a stop loss below yesterday's low. And the second trade is in Bajaj Finance. Now, this stock has been an underperformer in terms of price performance, but surprisingly, the January series has started off on a very high note. The long additions have been prominent. It has moved out of the slight consolidation range, and at 7430, it makes a case for a good trading buy at the current rates. Consider buying Bajaj Finance at the current rates for a target of 7692 with a stop loss of 7310.
Interesting. So watch out Syngene and Bajaj Finance and NBFC and a healthcare name. Not surprised that healthcare stocks are featuring there. We'll just we'll mark the pre-open session, no problem. But keep an eye out for all the stocks that we've mentioned. Just to round up the key set of stocks to monitor in the session today, viewers, for people who've tuned in. One, the Adani Group stocks will be in focus not at 9:15, but at 10:30 when the verdict comes out. Maybe some bit of preemptive trades could happen, but the larger focus at 10:30. Two, Avenue Supermarts, there is Bank of Maharashtra, there is Moil, and there is Rama Steel Tubes. All of these would be in focus today because there is some Q3 update that have come into all of these. And we'll try and tell you what those updates were as well and talk to Mayuresh Joshi about which of these fundamentally does he like. But these are the pre-open session. These are the rates on the pre-open session. All over the place. Remember, the implied open was much lower, so we'll likely start off lower. The question is, does the Bank Nifty crack or does the Bank Nifty find some support at slightly lower levels if it goes lower? But Mayuresh, to you, Avenue Supermarts, store count addition disappointing. The run rate at Q3 lower than the CAGR. Is that a worry for the stock?
It should be, Niraj, because I think historically over the past few quarters, they have not probably lived up to expectations. And therefore, the core parameters that they worked on, specifically in terms of the EBITDA per square feet, I think that probably is a little bit under duress as we speak. Obviously, this also indicates a bulk of consumer discretionary spending still being a little bit soft, which also makes it a very interesting fact, Niraj, on how FMCG volume growth will be directly or indirectly when you're talking about either urban, semi-urban or rural India. And therefore, I think what was expected in terms of the core parameters that Avenue has been always expected to deliver has been soft over the past few quarters. Store additions is something that they have to aggressively look at if they have to meet their target as well, which means further accelerated capex, drawing down on their cash flows in the next few quarters as these stores mature. So my own sense is that this stock will go into a deep price and time consolidation because valuations already are pricing in and are already at elevated levels.
Okay. So, well, watch out for Avenue Supermarts as well. Mayuresh, would you preempt the flavor in the Adani Group stocks ahead of a significant verdict today, or would you wait for the verdict to come out and then take a call?
No, we don't preempt, Niraj. So I think let the verdict come out. I think that's a more saner strategy. Let the verdict come out, let the street gestate what the verdict is on either side, and then we probably take a call. So I think no point in preempting the entire group before the verdict. But obviously a couple of stocks within the entire pack is something that you should probably keep an eye out, just keep on your watch list. The cement stocks, both ACC Ambuja, as well as Adani Ports, because I think these are good structural stories within the entire group as we speak. But again, no preempting, waiting for the verdict.
You know, and Adani Ports was up, as we were talking about as well, yesterday, by virtue of the fact that the numbers were okay. There is a, well, it's not an equity fundraise, but a fundraise meet today as well, so that's to be watched out for. The standard disclaimer, of course, Adani Group owns NDTV and you're watching NDTV Profit. Again, the charts may change depending on what happens at 10:30, but Akshay, do you have a view on any of these 9 or 10 listed companies within the group?
Well, on the chart front, see, most of the stocks from the Adani Group are very strongly placed. All of them have seen, especially the ones which have exposure to the futures and options segment, have seen longs being rolled over to the January series. The chart structure still signals positivity, though they might jerk for trading for intraday perspective. But chartically, I do not see any reason why you should panic. So in case you are holding on to the stocks, at least for the stocks which have exposure in futures and options, that Adani Enterprise and Adani Ports, at 3,000 in Adani Enterprise would be a stiff resistance to overcome, considering the fact that you have a lot of derivative call writing bets placed at the strike of 3,000. Once 3,000 kicks off, then you have the momentum kicking in very strongly in Adani Enterprises. So keep a watch out on 3,000 level, how it plays out there. My bet is that it should hit 3,000 very soon, maybe today itself. 2,800 is the support you need to work with. Till it is above the support, you have no reason to worry. And Adani Ports, this also has a very strong chart structure, in fact more stronger than Adani Enterprise, and it should be overtaking its recent swing high. 1,100 is the level where call writing bets are positioned. If this level is taken off, again expect a strong momentum uptick. So ahead of the verdict, if you have to take a bet on, I would say let's wait for the verdict, but options is the way to go. So in case you need to take a bet ahead of the verdict, then buy call options in, because your risk is anyway contained to the premium loss on the event in case you get it wrong. But my sense is the charts are positive. Stay with the flow and be on the buy side.
Akshay, coming on Bank Nifty, the weekly option expiry is what we are eyeing. A few days ago, you'd imagine 48,000 around those levels would be taken out. But now that looks very unlikely given the very subdued trade, the weakness, the profit booking we are seeing at higher levels, and the whole pack really looking largely weak. How would you trade Bank Nifty? Would you be brave enough to consider maybe a short position on Bank Nifty for the next few days?
Well, firstly, today being the weekly expiry for the bank index, if we just focus on how things might span out for intraday trading session, there is a lot of put writing bets placed at the strike of 47,500. So my sense is that just going by the technical parameters and the derivative placement of options, there is a good chance that Bank Nifty should try to stage some kind of an intraday bounce back once it nears the level of 47,500 to 550 zone. So be on the watch out. Slight dip around 500, 550 would be exciting levels as a weekly trader to take a buy position. Keep stop loss below 47,350 on the buy trade. And in case you see a recovery, yes, maybe 150, 200 points is what at the best it can give you. On the flip side, 48,000 is a very strong resistance zone for the Bank Nifty for the current week and also for the next couple of weekly expiries. So my sense is that for today, yes, the bounce back which I'm speaking of is very much on the cards. But if you were to take a monthly view, then again, you have an overstretched Bank Nifty, and sanity demands that Bank Nifty should eventually cool off as we head into the January series moving ahead.
Right, that's the word coming in on Bank Nifty. Mayuresh, you want to come in on banks? Some of the smaller banks have given their updates. So Bank of Maharashtra has come out with an update. RBL also some news where they've sold their non-paying credit card NPAs for about 800 odd crores. Yes Bank has given a business update. Punjab National Bank is updated on the global business. But more importantly, I think it's the big daddy HDFC that we'd all want to know about. What are you doing with the banking space? We did anticipate that if FI flows had to come back, they would be going into the quality large cap names like an HDFC. Seen a little bit of an action over there in the last few weeks, but nothing significant yet. Still some room to go out and buy HDFC?
Yeah, I think from a valuation perspective, obviously the large caps are giving a better risk reward as we speak at this juncture. And if you would have seen HDFC Bank, ICICI Bank have hardly delivered any sort of meaningful returns over the past 1 year compared to the larger universe, and in fact the smaller peers, including the private and the public counterparts. Having said that, the expectations in terms of how numbers will play out, a decent set is again expected this quarter. And with rate cuts, which are expected largely in this calendar year, in the second half, more specifically, I think there can be increased expectations of strong earnings recovery as far as NIMs and spread are concerned for the second half. So stocks like HDFC, ICICI Bank, IndusInd Bank would definitely be on our watch lists. But what we like is very selective names within the public sector universe. Apart, obviously, leaving aside State Bank of India, Bank of India, Samina, is something that we continue liking at MarketSmith. Our take is that the advances growth for Bank of India should be reasonable enough. What they've probably done in terms of their asset quality, along with a lot of other peers within the same space, have been exceptionally good. And the expectation largely is that a lot of recoveries and upgrades will play out for all these players as we head into the next few quarters. So to that extent, I think the bottom line growth can be significant as these recoveries upgrades take place, along with steady state improvement in the second half as the rate cut cycle earnestly begins, aiding a lot of balance sheet growth and return ratios as well. So watch out for the larger names which are on our watch list, Bank of India, which we probably like at this time.
Okay, some other stocks to focus on today. Mihika is here to talk about the key stocks in news as well. Mihika.
Hi. So first I'd like to start with Hero MotoCorp. They've come up with their December sales number. Now, in terms of motorcycle sales, it stood at 3.54 lakh units, but it was down 1% year on year. Whereas the scooters, which was the units sold were 39,294, it was up 5% year on year. Now, the domestic sales portion, which is majority of their business, it was the sales number was down 1% year on year, while exports was up 25% year on year in the month of December. But when you look at from the Jan to December period, 54.99 lakh units were sold, which shows a 5% year-on-year growth. And in terms of the near-term future outlook, the company expects, the sales momentum to be positive from the fourth quarter, and it will benefit from the increased government spending, the improved liquidity, the upcoming marriage season, and also encouraging farm activity. Then we also have a Rail Vikas Nigam, which has signed an MOU with REC, which will lead to mutual benefits for both the companies. Now, RVNL will present bankable projects with assured or projected sources of revenue, while REC will explore the scope of financing and will also pre-stipulate the conditions and the returns the company will get. And it's also, the Rail Vikas has also received a letter of acceptance from the Southern Railway, which is for a major upgradation/redevelopment of the Varkala-Sivagri railway station. Now, the contract period is for 30 months and the contract value is at 123.37 crores, and RVNL share amount will be 60.45 crores. And lastly, we have Arihant Superstructures, which has added a new plotted development project in Navi Mumbai, which spans around 118 acres. Now, the project is acquired partly on an outright basis and partly in a JV transaction, where the transaction is, supposed to be completed within the next 6 months. And the total development potential of this space is 2 million square feet. Now, according to the management commentary, the company is focusing in the diversification in the horizontal developments over the last 1 year, which is leading them to increase their offering base in MMR, and their total land bank is set to cross 335 acres.
Right, thanks for that. Those are a bunch of other stocks that we would be eyeing in today's day of trade. Of course, significant in terms of what those numbers are from the likes of Hero MotoCorp as well. Mayuresh, what did you make about these auto numbers that we've seen? Management for most of the auto companies has indicated that their numbers for December are in line with their expectations, and of course they look a little subdued because of a high base effect. On the contrary to what brokerages have made of these numbers, the street seems disappointed, brokerages seem disappointed. So clearly, I guess there's a bit of a divergence there in terms of what the internal expectations are versus what the outside expectations are.
Well, that will always exist, Samina, but I think December numbers are always expected to be a little bit more soft. But a large part in terms of the construct that this industry probably has, whether it's two-wheelers or the passenger vehicles, obviously MHCV is going through a sticky phase as we speak. But for the two larger legs of the market, the more retail-oriented legs, the footfalls have been extremely strong. The order backlog remains extremely robust. Obviously, there has been an increase in input prices, specifically specialty steel, by virtue of which I think a lot of auto companies have taken price hikes. But to that extent, again, I think the kind of numbers that we are talking about should sustain as we head into the next few quarters. More launches expected on the EV platform side, both for two-wheelers and four-wheelers. And all these launches are getting very well received. But you've got a huge kind of a waiting period in terms of new launches that have probably happened. The second element, obviously, is that input costs are expected to remain stable henceforth. And therefore, the margins should relatively be stable for most automakers. Obviously, the transitionary phase and the kind of capex that they've put both in their electrical mobility platforms, as well as the R&D that probably goes into the same as well, that might take some element in terms of the overall bottom line number. But as these new launches takes place, I think the numbers will start reflecting very, very positively. Obviously, a lot of stocks have moved quite significantly. Valuations are no longer cheap compared to the standard deviations, specifically for two-wheelers. So anybody holding on these stocks can definitely ride the momentum. Maruti is the only stock within the four-wheeler pack that probably stays close to the pivot levels as we look at it at Market Smith India. So therefore, if Maruti is able to deliver on numbers in the next couple of quarters, there should be some sort of come back and re-rating that the stock can probably offer. So from a risk reward and the margin of safety perspective, I think Maruti probably remains the only stock within the four-wheeler pack at this juncture that can be an action.
We've got a minute to go before I quickly toss it over to Niraj. But Akshay, very quick word on VST. Did you track this one? 20% yesterday, pre-open indicating another gap up this morning.
Would you mind repeating the stock name, please?
VST Industries.
VST. VST Industries, yes, a fab move, 20% up on circuit yesterday. And chartically, it's given a breakout. 3,800 was the point where the momentum kicked off. It's a monthly breakout, you can say 3 months breakout that gives you a target of 47.50. So yes, it's going to be a gap up opening. 47.50 is the area where you take your profits off the table. Positive view till 47.50. The support is 48,500, 44,000. Sorry, 4,000 is the support which you need to work with. Target 47.50.
4290. You know, can we just pull up one or two of these stocks? So VST Industries is up about 5% today. We've seen the Adani Group stocks being active. Adani Green in particular is up 5% today. Some of the wind energy stocks like Inox Wind Energy is up about 5% today. So a lot of these stocks, VST, Adani Green, Inox Wind Energy, some strong moves there. But here come the markets open and see what's happening onto the Nifty. Well, actually a lot better, I must say, than what the implied open was suggesting. So that's a bit deceptive. It's not cracked really, the Nifty 50. So about 0.2% or 0.25%. Let's pull up the banks. They were the main culprit yesterday and remain the main culprit today. I wonder if IT or FMCG is actually stalling that kind of a fall. IT is down 1% as well. Okay, and the Nifty is just about 1/3%. Can we pull up the heat map? Forget the mid caps and small caps. Pull up the heat map. I'm interested in seeing what's holding the index up higher. Okay, it is the Adani Group stock. So Adani Enterprises is up 4%. Adani Ports is about 3%. Reliance is flat. So this is what is holding the index up a little bit, because otherwise it's a large tick of red. Wipro, Infosys, HCL Tech, all three starting off in the red. So that is the first piece of news. We know the bank Nifty is in the red, but I don't see HDFC Bank in the list of the top 20 losers. If anything, HDFC Bank is lying flat. So it's still holding fort today, HDFC Bank, while some of the other banking stocks might be a bit soft. So that's part two. But I think the story unequivocally on the losing side has to be what's happening to the IT stocks. And on the gaining side, what's happening to the Adani Group stocks. Pull up Adani Enterprises individually, pull up Adani Ports individually, and I'm sure Samina will highlight some of the others as well. But clearly, ahead of the verdict, there is no constrained buying that might be happening into these stocks. If anything, it's a very sharp uptick on the index names for Adani Ports and Adani Enterprises. And I dare say that might well be the case on the volume front as well, and maybe at the broader end of the spectrum too. At some point of time in the show, we'll try and figure out the volume data right in the first 1 hour for these stocks versus the normal. But I suspect that the volume data will be high for both of these names, as also some of the others. So, I mean, I'm sure the broader end of the spectrum to these stocks are really taking it higher.
Very, very similar. So I think the day belongs to Adani, and I think the reaction you're seeing on the benchmark, mid-cap and small-cap counted, where they're holding out is only because some of these Adani stocks are, not some of them actually, all the Adani stocks are rallying up ahead of that verdict later today at 10:30. Niraj highlighted the Nifty movers in terms of Adani Enterprise and Adani Port, which are keeping the Nifty together. But across the broader markets, be it Adani Energy, Adani Total, Adani Wilmar, Adani Power, Ambuja, all those counters are up anywhere in the range of 5 to 10%. Adani Energy in particular is up about 10% in trade on very, very large volumes. So the top 5-7 gainers from the broader markets is the Adani pack, literally in that order. Well, moving on from Adani, which is the big talking point, and the mid-cap, remember, has opened slightly higher, getting support from Adani stocks, like we've said. Well, let's move on from there and take a look at some of the other names. Couple of bulk deals. We saw VST see a very sharp rally in yesterday's day of trade. It went up about 20% on back of Radhakrishna Damani picking up stake in the company. 1.4 lakh shares were bought, and more importantly, he is the single largest shareholder in VST. The counter gains today as well, up another 5% in the session. PDS saw some stake buy coming in from Malabar Investments. Sumit Nagar picked up a stake in the company. The stock was down 2% yesterday. The apparel major up about 4% in trade right now. Strides had Akash Prakash increasing his stake there, so not back of that, the stock is up 2.5%. Couple of other names that are worth mentioning are Shah Metallics. They've launched a QIP, which comes in at a 10% discount. The issue size is 1,152 crores. No big reaction, though, on the counter this morning. Quarter updates came from Avenue Supermart, Hindustan Zinc, MOIL. We'll take a look at how the market is reacting to that. Avenue numbers were slightly disappointing in terms of what the reports from brokerages have said. Remember, the likes of Citi continue to maintain a sell call on Avenue with a target price of 3,100. The stock reacting negatively. It hasn't done much for the year either. In fact, it's also down over the last 2 years. The stock is trading lower. On back of numbers coming in pretty healthy, monthly numbers coming in pretty healthy for the likes of an MOIL and Hindustan Zinc. Both the stocks are trading higher. MOIL is up with a massive rally of about 3% Hero MotoCorp, like every other auto major, their numbers were slightly weaker than expected for the month of December. The stock is seeing a cut of 1.6%, pretty much what every other automaker has done post-December reporting. Niraj, that's pretty much what I have. There's also the likes of an Alok, which is seeing a big jump, 20% jump in volumes. The stock is up 11%. But anything else you're picking up, Niraj?
No, I mean, it'll be interesting to see, Samina, that while the, how do we say, the dichotomy playing out between what's happening in IT versus what's happening predominantly in the Adani twins, but also some of the others. But the broader end of the spectrum is punctuated, one, as Samina said, by gains to all of these. There's Sterling Wilson Solar up about 4%. Lemon Tree continues from where it left off yesterday, up about 2.5%. So that is doing well for itself. Metro Brands is about 1.5%. But the gains are very measured, and the index about 0.25%, so nothing too dramatic. Okay, first set of questions to our experts. To Mayuresh, I'll ask about the bulk deal winners, but Akshay, to you first, opening thoughts. I know you had a call on Bajaj Finance. It's open flattish to marginally higher. Would you still go ahead and buy it? And two, does this sharp gap up negate the possibility of taking a trading position into any of the Adani Group stocks, or does something look still strong? Because almost every stock has opened in the green.
Yeah, so to answer the first question about Bajaj Finance, yes, I will go ahead and take the buy recommendation which I have shared on your channel. The targets are intact. It's a positive setup. Continue with the buy trade. And moving on to the Adani pack, also I mentioned that Adani pack chart structure is absolutely strong. There is no reason to panic, and the gap up today just suggests how things might unfold as we go through the day. Yes, at this point, if you take a buy trade or not, that's the question. I would again suggest options is the route to go. If you feel that still there are more gains in the offing, because right now, as we understand, Bajaj Finance, Adani Enterprise and Adani Ports both have staged a breakout of the levels which I gave in the morning. So consider taking a buy trade, but go through the option routes, because here your risk will be contained. There will be volatility after the verdict, but I have no doubts the chart structure absolutely strong, and continue to be positioned on the buy side for the Adani groups, whichever stocks you name it.
Just wondering, Akshay, do you do options at all, or do you only look at charts?
Both.
Okay,
I'm into derivatives and techniques.
So would you? Okay, sorry, excuse me for that. So would you look at any option strategy out here, or would you wait for the verdict to out of the way? It seems that the market is not waiting for the verdict. See, I'm kind of forced to ask you about these because these are the ones that are making the largest moves on open.
I would be more comfortable taking a strategy in Adani Enterprise. If you use the option route, the current rate is 3078. So consider a bull call spread here, where you go for buying a 3100 call option, and you can hedge it by selling a 3200 call option. So what happens here is, even if there is some price volatility after the verdict, you are hedged to the extent of the calls you are selling, and you also have space to hold on to this trade for the January month. My view continues to be positive for Adani Enterprises. I'm looking at targets of 3100 plus in this month of January. This may surprise you today itself in case it gets past the highs of 3150, which was seen a few trading sessions back. So positioned, be on the buy side. Use a bull call spread to time this move. That should keep you in a very comfortable space before the verdict.
Samina, the only thing that I would add to this is, and if indeed the verdict kind of clears most of the other things that are pending, in some sense it's poetic justice, because January was the month where the saga started, 2023, January 2024. And in some fashion, more than that, Adani Enterprises, the flagship, is now at the price at which the fund, the stock was at 4,000, but they were doing the QIP, which they then withdrew. But the QIP was being done at circa 3,100, 3,150. We are now seeing the stock just around those levels. So in some fashion, it's a very interesting confluence of events and prices as well that are happening here.
And for a business house in this country, which is so significant, this also means a lot for India Inc. So if you've got to broaden the conversation and just move beyond what it does to the group stocks, the fact that the street is excited, traders are placing their bets, the counter's also seen a recovery. We've had management, increase their stake, put in some money, raised funds, and the stocks are for everyone to see. The reaction on the counter in the last 6 to 8 weeks has also been commendable. It's definitely a show of strength, show of faith, and it's almost a win for India Inc., I'd imagine.
Yeah, I mean, on the infrastructure story, I mean, for such a large group, which is so predominant out there, and they've put the money where the mouth is, right? Adani Green, the fund infusion was done, not at a significant discount to the current price for the warrants issue. They did it just around the market price, maybe a 40-50 rupees discount on a price of 1,500, 1,600. So, yeah, pretty stellar and already in the money. But there is a market beyond this as well. So let's talk about those. Mayuresh, 3 bulk deals that happened overnight and some smart moves on each of those. No, sorry, I think that rate was wrong. But 3 bulk deals that happened overnight, and the market is giving a thumbs up to all the 3. VST, PDS, and Strides, wherein Amansa, Akash Prakash is logged in. I don't know if you fundamentally track any of these names.
So, just a brief on VST. But generally, I think the kind of pedigree investors who come in VST, obviously the reaction is for everybody to be seen. But just one aspect here, I think the balance sheet dynamics are extremely strong for VST. The EBIT margins at 31%, the return ratios, specifically ROEs, in excess of 25%, because the kind of business they are in, pricing and margins are extremely high. Obviously, the only aspect that needs to be now seen is what happens around the interim budget, anything around syntax, and if there are no moves around that. I'm pretty sure, I think the larger counterpart, which is ITC, which trades at a little bit of higher valuation, at least as far as the cigarette business is concerned. Probably all these stocks might continue doing well if there are no negative surprises. Obviously, from the pharma name, don't have a coverage there as well, but something like a Torrent Pharma, Niraj, on pullback, something like a JB Chemicals on pullbacks is something that we like at MarketSmith India. Our sense is that the branded generic space will continue doing well because the pricing will still remain intact for predominantly these players. The second aspect in terms of more products being introduced for the regulated markets over the next few months and quarters will augur well as far as earnings are concerned. And then margin profile will remain extremely strong and steady state in the next few quarters as well, giving a good revenue and earnings visibility as far as FY25 numbers are concerned. So no specific view on all these bulbs, but these are a few stocks that we probably like at markets.
Thanks for that. Well, Akshay, I'll come to you as well. 2 spaces that are in focus, and I don't know whether Niraj has discussed this with you, but anything in the pharma pack that you'd consider going long on because those counters today aren't as active as they have been in the last few days. And also a quick word on tech ahead of earnings, any positions being instilled?
First question on pharma space. Yes, as I said, the money is chasing pharma stocks and it's been a good start for the January month for most of the pharma names. Divi's Lab here specifically is very strongly positioned on the technical charts. Although it is trading flat right now, yesterday we did see a strong breakout on the charts. There was long additions in the futures and options space. So the breakout was seen at 3950. Your support is around 3950. I'm looking forward for strong upside in the month of January in Divi's Lab. You can have targets of 40 to 50 plus. So Divi's Lab will be on my watch list, on my buy radar with a stop loss below the supports I gave. And can you please, I missed out the second question, if you don't mind repeating it.
IT, any trades that you would do on the IT pack ahead of numbers?
Yeah, ahead of numbers in the IT space, well, see, IT has been a very strong sector broadly, going by the derivatives and the technical price action in the last few trading sessions for the January month. But some profit booking is evident ahead of the result season. A couple of names here which come to my mind based strictly on the technical parameters. One would be HCL Tech and the other is Tech Mahindra. So these are the two stocks which I would consider to be on my buy watch list ahead of the result. HCL Tech has a strong support base at 1425 to 1430. So slight dips makes it very attractive from a risk reward perspective to take a buy trade. I'll keep a stop loss at 1400 and keep a target of 1500. That's HCL Tech on the buy side for you. And Tech Mahindra is the another stock in the IT space which technically attracts me to take a buy trade. Again, I would wait for a slight dip till 1240, which makes the risk reward more attractive. Target would be 1320 and the stop loss would be 1225.
Akshay, we'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time and your thoughts. Mayuresh, before we wrap up, maybe we spoke IT, maybe we didn't, but everybody's going gung-ho IT. We have about 60 seconds before we need to slip into a break, Mayuresh. Any thoughts on large cap IT? Would you buy or would you wait?
No, we will wait. So I think I will wait for numbers to come out. We still remain constructive on a couple of names within the mid-cap space, Niraj. We like stocks like a First Source and a Cyient, where our belief is that the kind of product suite that both these companies have, FSL in generative AI, Cyient has got a very good product mix as far as the enterprise solutions are concerned. And therefore, revenue growth, margin stability, and expectations of good bottom line growth can very well continue for both these counters. So very, very selective here, but FSL and Cyient is a few stocks that we like.
Right, thanks, Mayuresh, Akshay. Great having both of you today with us. Of course, talking about market opening. In the meantime, it's not looking too bad for the street. Thanks to the Adani Group, the market's not falling off a cliff this morning. The Nifty sees some amount of profit taking, but nothing really to be too concerned about. 21,620 is what we trade at, 45 points off on the Nifty. The breadth of the market is biased towards the losing stocks. So you've got metals that are weak. IT continues to see some selling pressure. You've also got some of the banking names that are coming off quite sharply. On the winning side is Adani Enterprise on the Nifty 50, up 5% on large volumes. Adani Ports as well, trading with a gain of about 3%. In terms of the broader markets, stocks that are catching our attention for obvious reason, again, is the Adani pack. Adani Enterprise is up 4.5%. Adani Ports is up 3%. You've also got Ambuja, that is trading positive. Adani Wilmar, Adani Total are all trading with deeply in the green. One space, though, that has been catching all our attention has been Allcargo for the last 11-12 days. Business restructuring is what we saw on the counter. Today is one of the first few days that Allcargo Logistics post. Of course, the cutoff date yesterday is trading subdued, down about 1%. But remember, there has been business restructuring where the company is easing the structure and splitting up the export and the local business and keeping that as two separate businesses. We'll take a break. We'll come back. Ravi, Jakhar, Chief Strategy Officer of Allcargo Logistics, joins us on the other side. So stay tuned. Welcome back. The markets are having a quiet day. Adani is ruling the roost. Across the board, big gains coming in on the Adani pack ahead of the verdict that's expected at 10:30 a.m. Well, that's the pack, and it's in front of you. And one stock that caught everyone's attention has been the Allcargo Group companies. The stock has been on a tear, and I'm talking about Allcargo Logistics for the last few days. Of course, today is having a subdued morning after it went ex-bonus yesterday. Ravi, Jakhar, Chief Strategy Officer of Allcargo Logistics, now joins in. Ravi, we've been trying to get a hold of you for the last 10-12 days, but finally get a chance to talk to you this morning. Thank you. I want to, of course, we've read about this. You've had a few brokerage reports as well talking about the rationale. You've talked about it in your presentation, about the rationale behind the restructuring. Just for people who are tuning in, who are not up to date with what's happened in Allcargo Logistics, break it down for us, simplify this for us. I know simplification was one of the key objectives, but for the sake of our viewers, simplify this business restructuring that the company has gone through, and I do believe this is the last leg of it.
Absolutely. So this is the final step in our last 3 to 4 years of efforts which have been going on for a transformation of the business and restructuring. The idea is simple. We have built beautiful businesses which have now been put into a very simple corporate structure. All the non-core businesses have already been exited. We have already sold a lot of non-core assets. And what remains behind are the 4 flagship businesses. 2 businesses, as part of the previous restructuring, are already now listed on the independent companies. And now this final leg would split the international supply chain business, which we operate in at AQ Worldwide, and the domestic business into 2 separate independent companies. What this simply means is that each company is listed on its own as an independent entity, has the strategic independence and the financial flexibility, which bodes very well for these companies to drive the next phase of growth. As you know, Allcargo Terminals is already an independent company that's the largest CFS operator in the country. Now, with this restructuring, our flagship international supply chain business would get demerged and list under Allcargo EQ Limited. This is the flagship business in which we are global market leaders in LCL consolidation. And what remains behind are 2 beautiful businesses, Express Logistics, where Gati has been the pioneer in the industry, and now with the contract logistics business also amalgamating under one entity, it would become a domestic supply chain powerhouse, which would house both Express Logistics and contract logistics. And that means quite unmatched capabilities from a end-to-end integrated solutions perspective, because clients would be offered both warehousing and distribution solutions. That's a pretty powerful combination, which will get created as an outcome of this restructuring. And what you would eventually have is 4 listed companies, 2 which already exist separately as 2 businesses in the Allcargo Group, that is Allcargo Terminals and Trans-India Real Estate. And the other 2 businesses would now list as Allcargo EQ Limited, which is the international supply chain business, and Express and Contract Logistics would merge into Allcargo Logistics as one company. So very simple structure, independent boards, management teams, driving growth and digitization in these asset-light businesses. And currently, if you look at the holding structure, it's quite complicated with a lot of subsidiary structures, which have been, because of legacy reasons, we had multiple partners in the past. Over the course of last 1 year, we bought out all the partners, and now we were able to launch this scheme, which has been approved by the board and now would be tabled before the regulatory authorities and shareholders, etc., for the due process. And by sometime around end of this year or January 2025, we expect all of this to get concluded and the end result to be before us.
Let's try and quantify this, because that is really what I think investors will also be looking at this for. And I want to start by the express and contract business. That is about 1,800 odd crores of combined revenue. Margins around 10% is what I believe. How will this current efficiency that you're driving at the group level aid your margins? And immediate impact is what I want to know. And also the outlook, the guidance internally, the objective that you have on top line and profitability over the next maybe 2 to 3 years, because that gives us a good runway to assess what should an investor strategy really be at this stage.
Yeah, so talking about the domestic supply chain business, which is Express and Contract Logistics, you rightly said it is ballpark about 2,000 crores revenue, 200 crores EBITDA. That's the kind of scale of business we're talking about. And no holding structures. The listed entity itself would have the operating businesses in the company. In terms of the market, as you know, Indian economy has been on a boom, and we estimate the domestic consumption to continue to grow very well over the next 5 to 10 years, which means that the domestic logistics would continue to do well. On top of that, there is also a formalization in logistics, which means people are moving away from unorganized transport to more organized express logistics. In time, supply chain is more critical. People are looking at organized warehousing. What all of this means is that express and contract logistics as an industry by itself would continue to see healthy double-digit growth in many years to come. On top of that, we are quite confident as a company that we would outgrow the market and expand our market share in the express and contract logistics space. So therefore, from a top-line perspective, the company should continue to grow faster than the market growth rates. And we also believe that with the combination of two businesses, there will be an opportunity to optimize costs. We should be in a position to rationalize the management structures. We should be in a position to better serve the customers, which means there could be incremental business which could be generated. So all of these factors should be margin accretive for the express and contract logistics business combined. So that's the outlook for that.
Yeah, Ravi, and I've talked to analysts for the last 10, 12 days, and if anyone's talked logistics, they're very, very constructive on your company. You said that there would be double-digit growth, and I'm guessing if you're going to go ahead of the industry, late teens is possibly what you're looking at. If your top line stands at 2,000 crores, if I had to add 20% to that, would that be a fair expectation, or am I being too ambitious in terms of top line growth for the next year? And margins as well, how much more? So 100 basis points, 200 basis points, are we going from 10 to 12, 10 to 14? Some indication would be helpful, right?
So I would stay away from, firm guidance on the numbers. But like I said, on the top line, we would grow faster than market. And on the margins, we would continue to see an improvement on the current margin profile.
Okay, I'm going to move on from that, and I'll come back to fundraising in a minute, but let's talk about your international business. Globally, I know things have been slightly quiet, and you've talked about this, where the last 2 quarters have not been ideal, but things are about to change, and that's the hope we have. How much of market share do you own in the global marketplace, A? What sort of revenue growth are we expecting there? Are we even expecting revenue growth? Because if the vertical is not looking great, there could be a chance of reduction in revenue there as well. So market share, and what is the sort of expectation we can have in terms of outlook for the next year or two on top line and margins?
Yeah. So our flagship business is LCL consolidation. In the LCL consolidation business, we own approximately about 15% of the neutral LCL business. And that's the global market share in all the countries that we operate in. As you know, more than 60 countries, we have our own offices, and that's where covers almost all the key countries in the world. We are a dominant player in Western and Northern Europe. We have strong presence in India and several countries in Asia. We are market leaders. And the global scale as well, we continue to remain market leaders by far in the LCL consolidation space. In terms of growth, you are right that there has been a tight environment. There has been a bit of a recession on the Western Europe. There has been a bit of decline on the consumption side. But what we see now is that inventory levels across the world are at the lowest levels possible, which means that further inventory rationalization looks unlikely. And we also read into the economist outlook reports, and most of the economists seem to be suggesting that there should be some bit of a gradual improvement through the second half of this year. So as you know, February is around the Chinese New Year, post which typically the shipping cycle resumes. And from around June, July until September, October is the peak shipping cycle. So considering that the inventory levels have already been rationalized and considering the demand is now coming back, we estimate that the second half of this year should be a more normal year with growth in global trade. Next 3 to 6 months may remain limited growth or no growth for the next 2-3 months. And that is where the focus at this point in time has also been on cost rationalizing and cost optimizing, which we've been doing for the last 6 months. And the impact should be visible to an extent in the quarter of ending March and more prominently in the quarter ending June, as some of these costs would also be backed by severance costs, which kind of get negated. So first half of the year, we'll try to see what best we can do internally in terms of cost optimization. And the second half of the year, calendar year 2024, we believe that market should also back to support in terms of driving growth forward.
Right. Ravi, another quick last question before I completely run out of time. At your board meeting, the fundraising plans were also approved. Now, you clearly have a very healthy balance sheet, free cash flow positive business. Why are we looking to raise funds here? Is it going to be for inorganic expansion? Because you have talked about expansion, increasing market share, could we expect acquisitions around the corner? And also a timeline of this fundraising. Is this going to be next quarter? Is this going to be over next year? What is the timeline approval that the board has given you for this? It cannot be indefinite, I'm guessing.
Yeah, so as you rightly said, the businesses are well positioned. The balance sheet is quite healthy. The net debt across the group is almost negligible. So from that perspective, we're in a good position. In terms of the businesses, international supply chain business doesn't require much of capital beyond asset-light digital approach that we have taken, and which means some investments on the tech side. On the domestic business, again, there are opportunities to invest in technology and infrastructure upgrade. The board has approved looking at fundraise by way of various instruments, and we are now placing it before the shareholders. So we would evaluate the exact timelines, but definitely we're not looking at something beyond this year. So within the next 6 to 9 months, we're looking at some fundraise. What quantum is something which is still under deliberation. We would look at a plan, but I can comment that at this point in time, we are focused on organic growth and digitization. We're not looking at any acquisitions at this point in time. So any fundraise would not be towards funding acquisitions.
Right. Exciting times there, Ravi. Good luck. I guess you've got a lot on your plate, but things getting easier. I'm sure the street will continue to remain excited. And of course, good luck with increasing your market share and controlling the domestic, at least, logistics business. In the meantime, the markets are having a quiet morning, very similar to what we've seen in the last 2 days. Tight trading range, bank options expiry later today. But we'll slip into a break. We'll come back, put the focus on Aisha. Vinod Aggarwal, MD and CEO, joins in on the other side.
Well, back with India Market Open right here on NDTV Profit. Not such a fine fettle for the markets, must say. About 0.5% odd lower. Nifty is below the 21,600 mark. And I reckon banks and IT are leading the charge downwards. On the flip side, banks are 0.5% lower. On the flip side, the Adani Group stocks are seeing a flight of another magnitude, really. All of them, without exception, in the green. But 11% seems to be that magical number, and I'm talking about Volvo Eicher commercial vehicles now, because that's the kind of growth rate that they've seen across those line items. And I have a bunch of questions for what it means for the industry as well with Mr. Vinod Aggarwal. He's MD and CEO of VECV, joins us right now on the show. Mr. Aggarwal, good having you at the outset. To you and team Volvo Eicher, a very happy new year.
Same to you. Thank you very much.
The pleasure is ours. Now, you know, there is, we've used the term resilience when we look at the growth numbers that have come in for December, arguably for Q3 as well. How do you view that growth, and does that lead you to make any kind of assumptions about what 2024 as a calendar could be like?
First of all, I think commercial vehicle industry overall, it is in good shape. It is going to be near its earlier peak year of 2018-19 in the current financial year 24. So therefore, I think since we are doing even better than the industry, therefore our YTD growth, YTD December growth this year in first 9 months has been around 12%. We are close to 60,000 sales as against 53,000 last year. And whereas 3.5 ton and above industry, that is a growth of around 8%. So therefore, we are doing better than the industry. And last quarter also, we are expecting good growth in the industry. So therefore, overall industry is in good shape, and we are doing better than the industry.
So are these the kind of numbers, and sorry, I know you mentioned the numbers which indicate about a 20-odd%, but when I was looking at December, that seemed to be the total bus and trucks division about 11.2%, total VECV about 11.1%, which is why I mentioned the term 11%. But my question is, do you reckon that's the kind of growth rate that can be anticipated in an election year, right, wherein the spends become a bit different than what it typically are for the remainder of the years for a lot of sectors, maybe including commercial vehicles as well?
Fundamentally, I think elections apart, we have to look at the fundamental factors that drive the CV industry. Now, the fundamental factors are the economy, infrastructure investments, and replacement market. I think all these three factors are remaining very, very bullish. All these three factors, we will see good traction. Therefore, based on the fundamental factors, there will be growth. Now, elections, there may be short-term ups and downs. There may be some slowdown in decisions because of the election code of conduct coming up in maybe in April or May. But then overall, I think it will make up. So even if there is some short-term hiccups, we don't see any concern as far as the elections are concerned. On the other side, we should look at the positives because of the elections, because you will see a lot of spend happening in the market because of the election. In fact, I was reading in today's paper only that around 100,000 crore is going to be spent because of elections in Q4. That may add up to some growth in Q4 GDP. So therefore, we should look at the positive side of the elections because of the higher spends in Q4. So therefore, overall commercial vehicle industry will do well, and of course there may be some short-term hiccups here and there.
But that notwithstanding, Mr. Aggarwal, would you believe? I mean, I hear bulls of the auto space, and particularly the ones who are bullish on the CV space, talk about a fairly fast clip of growth likely over the next 24 months. Now, my question to you is, if I had to ask you to paint a blue sky scenario, what would the factors of this blue sky scenario be? And under a blue sky scenario, Mr. Aggarwal, what is the kind of growth that you expect the industry to do or Volvo Eicher to do, either case?
No, first of all, I don't want to put any figure on this, that how much will be the growth.
Okay.
As I mentioned, we have to look at the fundamental factors. Fundamental factors are positive. Economy is growing from $3.7 trillion. Economy is likely to go up to $5 to $7 trillion over the next 3 years. So that is very clear estimation, and everyone agrees on that. The second is the replacement demand. Replacement demand has to be strong because the new technology trucks, they are much more efficient, much more productive, much better features which deliver more productivity. So therefore, there is a lot of business case to make the replacement of the old trucks. So therefore, replacement demand will continue to remain very strong. And third fundamental factor is the infrastructure. If the fundamental factors are positive, now you have to see how fast the economy grows. If the economy grows next year also around 7% or 8%, when the GDP is around 8%, the truck demand or the CV industry demand is like little bit higher than the GDP growth. Like the GDP is 8%, on a linear basis, it should be higher by 2 to 3%. Therefore, you can put a figure of 10% growth if the GDP grows by 7-8%. CV industry should grow by 8-10% in a normal circumstance. But then added to that is the more replacements or more demand because of the more investments in infrastructure. So therefore, we are not concerned. We are only saying that industry is doing well and it is expected to do well. Now, how much it will be, I think we should not worry too much about that.
Okay, so let's put it this way, Mr. Aggarwal. I know you're not putting numbers, but just humor me. Between 10 and 15%, let's say 10% is the base, and then the technology, infrastructure, etc. Or let's say between 10 and 20%, whatever the number is for the industry, whatever the number is. Companies like you will probably do better than that. So let's say the number is slightly higher than that. Now my question is, would you believe that such a growth number, one, could last for the next 2-3 years? Part one of my question is that. Part two of my question, if indeed higher technology trucks, etc., are all coming to the fore, would it mean that companies with a technological edge in manufacturing like yours would stand to, of course, gain market share, part one, but also that the operational metrics could improve simply because you would command a better bang for the buck relative to some of the other products in the market?
Yeah, it's basically fundamentally the trucks are business assets. So therefore, the transporters or our customers, they look at that, which is the truck that can deliver them the least cost of ownership. So if our trucks can deliver them the least cost of ownership based on better fuel efficiency, based on better uptime, based on better features, like we are giving predictive maintenance based on our 100% connected trucks and based on our state-of-the-art uptime center. So if we are able to provide all these features which help the transporters to manage their business in an efficient manner, it makes a lot of sense for them to buy our trucks. So therefore, we are confident that we will be able to do better, and the customers should prefer Eicher trucks.
Okay. So growth numbers and operational metrics both would be better, I presume, is what you are saying.
Hopefully. That's what we always target.
Okay.
And in the past track record, we are delivering that.
Sure. Just one last question, Mr. Aggarwal, and that is on pricing. Would the pricing hikes be a factor of the cost increase, and have they happened at your end too? Because I believe Tata Motors and some of the others have announced that. And would you be in a position to take more price hikes during the course of the year based on demand?
I think more important than the price hikes is the management of discounts. The CV industry has suffered a lot because of heavy discounting all across. And because of that, even though on one side the price increases are made, if on the other side discounts also increase, then that becomes neutral. That's what had been happening in the past. So in spite of the pressures of input costs, the price increases even though were made, but the discounts were also increased. So we were not able to recover the cost increases in an effective manner, and that's reflected in the results of all the CV industry companies. So therefore, we are expecting that the discounts should get more and more corrected. And once you have the correction in discounts, I think there will be better realization and better margins.
Okay. Mr. Aggarwal, we wish you all the best for that and more. Have a fantastic 2024, and thanks for taking the time out and giving us your thoughts.
Thank you. Thank you so much.
Well, that's the view from Volvo Aisha. We need to wrap up this show, India Market Open, on the note that the markets are okay with banks and IT sulking in trade. On the other side of this break, though, Nimesh Chandan, Chief Investment Officer of Bajaj Finserv Asset Management, joins us on Talking Point. Thanks for tuning in to Talking Point. I'm your host, Niraj Shah, and our guest today is Nimesh Chandan, CIO of Bajaj Finserv Asset Management. The case for a chat today with him The most obvious question that comes to mind for almost everybody, that what will drive the markets higher, valuations or momentum? We'll talk about the mega trends for long-term wealth creation, and of course dwell on a topic that has been topmost for everybody, PSUs. And it's great to talk to somebody like Nimesh about PSUs, because I don't have a barometer of how he thinks about it, so it's a thought afresh from our perspective in understanding from him. Nimesh, great having you. Thanks for taking the time out. Lovely having you on Talking Point.
Good morning, Niraj. Pleasure to be here.
Yeah, the pleasure is entirely ours, I must say that. So Nimesh, at the outset, the first question is about whether you're constructive on risk assets, including Indian equities, for 2024 and maybe slightly longer, after what's arguably been a banner year, at least for the broader end of the spectrum.
So let me divide it into two parts. We track markets based on fundamentals, what we see, and we also follow certain behavioral indicators, which kind of tell us where the pendulum is leaning or moving toward, whether it is bullish sentiment or bearish sentiment. On a fundamental level, we believe we are very close to fair value levels as far as the Nifty levels are concerned. The small cap universe would be trading slightly above average of what they have historically traded. They are not into a bubble zone yet, but they are above average valuations. Nifty is close to fair value, and here then you have to be very, very specific on what you are selecting as stocks to invest in to actually create better returns. So 2024, while every year is a stock pickers year, but it becomes more so in 2024 because we are stepping into 2024 with reasonable to slightly higher valuations for many sectors. Now, on the other side, on the behavioral side, the pendulum is still bullish. So the indicators we track from different markets on different periods of time, we see the momentum to sustain, the bullish sentiment to sustain. It is probably fueled more by seeing the interest rates peaking and more flows expected to come into India. But those indicators, almost all of them are still on the bullish side.
Okay, and I was okay. Let's talk about the behavioral pattern in slight detail, because market-wide that has an impact. Viewers, a lovely book to read is The Crowd by Gustave Le Bon, way ahead of its time when the book came out, and gives us a great insight into how crowds think. But for all of you who can't read, let's ask Nimesh, how would the behavior of the public at large or the crowd at large impact what's happening to the already skewed mid-cap, small-cap end, even the primary market end, if you will, because clearly what's happening out there is indicative of some bit of froth. If not at the mid-caps and the small-caps, then certainly what's happening in the primary markets, Nimesh.
Right. So as you know, Niraj, that even when markets go into overvaluation territory, they don't fall immediately. The opposite is also true. When they are completely undervalued also, they don't start moving up immediately. There are always triggers, and that impact the sentiment of the crowd, and then leads to buying or selling based on the information that has come. So we track various markets and see how each market expresses its bullishness and bearishness. And we track global markets and different markets like commodities, currencies, bond markets, as well as equity markets. Now let's take an example. How do, say, metal markets tell you that they are bullish? So typically, when metal markets are bullish on economies and business cycles, they would buy industrial metals and they would sell precious metals like gold. So that ratio changing gives you an indication of what the metals market is thinking. Say the bond market. Bond markets typically, you see the spreads going down between corporate bonds and government bonds when they are bullish on the economy, when they expect the corporate sector to do well. And obviously the opposite when they are bearish. Look at equities. Equities are typically a little late to react, but the momentum on, say, small caps versus large caps, defensive sectors versus cyclical or, say, high beta sectors, these are the indicators that tell you what the crowd is thinking and whether they are looking to turn. So, for example, last few days we are seeing a good rally in pharmaceuticals. Now, that can be an alert that are people looking to more defensive positioning because the valuations have reached a certain level. We look at not
we don't expect all the indicators to give us a bullish or a bearish trend, but we look at what the majority are pointing to. And as I said, they are still pointing towards more bullishness, and I think that will push the momentum and will continue to move higher.
That's an interesting point you raised, because when we were looking at, I was looking at the list of equity funds that have done the best in 2023, and I know 1 year is not a good time frame to look at fund performances, but humor me, if you will, value funds came to the fore in a big way in 2023. Now, just using that as a barometer, that fund managers have moved towards buying some bit of value, right? I'm trying to understand if that pattern, Nimesh, continues well into 2024 when the markets are looking expensive. Would you, as a fund house, also largely stick to that kind of philosophy across your fund offerings?
It's an excellent point, Niraj. So what we see is typically cycles of 3 to 5 years between even styles that outperform for a certain period of time. This may not be an exact math in terms of exactly 3.5 or 4 years and things change or so, but it does give you an indication that what is the high probability from here on. Now, you are absolutely right. From 2020 onwards, there was a hunt for value, and we have seen now, at least in 2023, being expressed more strongly. But we've seen more like a 3-year rally in terms of value stocks and value companies. So I think a lot of that juice is already priced in. On the other side, what we see is the quality stocks, or I would say so-called companies which have steady growth, good return on capital, good cash flows, and were considered to be, say, in 2018, the safest bets to be in. Those for 5 years have kind of underperformed, like 3 to 5 years they've underperformed. And going into 2024, then I think that becomes a better positioning than value. Not that the momentum in value will immediately go down, but the positioning for an investor who's looking for where is the next wave coming, I think the positioning should be on the quality side.
Okay, but that's interesting, because I think the underperformance, I mean, they went through this bout, and I'm glad you mentioned cycles, because I think they went through this bout of severe outperformance, wherein it was quality at any price until maybe COVID hit, or maybe for 6 months, 12 months after that. You think the hibernation ends because of globally linked factors as well? Because a lot of talk around how if rates come off, then what happens to growth stocks and quality stocks versus what comes to value. Is that a factor as well?
So what we look for is which is a style or which is a sector or companies which are underappreciated or underpriced. Now, this is slightly different from value. So let's think of it this way: when market is focused on one side of, say, a theme with the sector or a certain set of stocks, those become overpriced, and what market is ignoring on the other side become quite attractively placed or underpriced. Sometimes value as a style becomes underpriced, so nobody's looking at value. Say if you brought a value fund in 2018 or 19, people would really wonder why you are bringing such a fund. Now think about it this way, that the quality stocks are underpriced compared to what the premium they used to have over other growth styles or value styles in the past. And that becomes underpriced or underappreciated. If I'm paying, say, a 40 or a 50 price to earning ratio for all the companies, I better pick up something where I know there is a moat, the business has a certain scalability and the return ratios are good, because that deserves a higher valuation compared to just a cyclical, say, a sector or a company that gets the same valuation.
Got it. Nimesh, but can't that last for a lot longer than what sanity might suggest as a change of style, right? We've seen FMCG counters back in 2010, right? 2010 go through that period of severe flatline performance despite the fact that they were high quality stocks and didn't do anything for such a long time. I mean, sorry to use this name as an example, but Avenue Supermart's high quality stock the last 2 years has done nothing, right? So can't that last for a bit longer? How are you so confident about taking this pivot, if you will?
So we look at, areas which are underpriced, and we also look at some triggers that can really come in. Now, many of these companies, if you see, which have underperformed for the last 3 to 5 years, are typically in the consumer sector, in consumer discretionary, say. We've also seen many of them, say, in the private banking side, where valuations are at a 5-year or a 3-year kind of a low, or sometimes even a decade low in some cases. Now we look at the trigger, whether there are any business triggers for them. We see on the consumption areas triggers coming in. Typically, when the economy does well, per capita income is growing, discretionary spends starts coming in. Also, when the capex cycle of a country starts, it has a follow-through effect into consumption. So because of higher employment, higher salaries, recruitment, you see then a follow-up coming in terms of consumption side also. You've seen certain areas where there was a kind of a revenge spending or a post-COVID kind of surge in travel, in hotels, QSRs, and so on. I think a lot of areas where, say, bottom of the pyramid was not doing very well, say on the rural consumption side of it. Now, these areas are showing some green shoots or positive vibes, and I think that those can be the theme for the coming year. No, you are absolutely right. Markets can continue to be valuing only, say, certain defense sectors, PSU sectors, which they have done very well in 2023. But a smart investor would know that this is where the fair valuations have come in. And with the visibility of these cyclicals versus the structural plays, it is time to start considering the structural side of the business.
Okay, we'll talk more about this on the other side of this very quick break. Nimesh, stay on. Lots more to talk about. Be back in just a bit, viewers. Back with Talking Point in conversation with Nimesh Chandan, CIO, Bajaj Finserv Asset Management. Nimesh, I heard you speak about triggers. I heard you speak about undervalued stocks. I would love to understand about pharmaceuticals because I heard you mention that space as well, if I'm not wrong. Now, tell us, because that pocket has been in flavor now for the last few days. Is this the market turning towards an underperforming sector, likely having triggers and valuations in its favor, or are there other reasons?
So pharmaceuticals had many years of underperformance, and frankly, when some of the IPOs came in, I was worried that why are they pricing it so high? But then the market started turning favorable towards the domestic-oriented stories first. And domestic-oriented stories are better to play pharma side, and then there's a few listings, and then the whole sector starts getting re-rated upward. Then there's some positive news that came from, say, the generic side or the US generic side, where you saw pricing kind of action bottoming out. There was aggressive discounts or packs earlier. Now the generic pricing starts bottoming out, so that comes as a fresh trigger for re-rating in pharma. However, in my experience, whenever the pharma sector overall moves together, I think it shows something about investors rather than the investment, that people are looking for ideas where they have some, say, a defensive kind of a growth play. And I think this is what has moved pharma as a club. Otherwise, each company has very different kind of markets that they cater to, different geographies, different therapeutic segments, different molecules, different R&D pipelines. So overall, I think the move in pharma is because it has underperformed for quite some time. They got re-rated upward now. From here on, we'll have to be more selective. We are bullish, and we continue to be bullish on the domestic pharma space because we see that as a structural story. We continue to be bullish on the other healthcare space where, say, hospitals or diagnostics labs are concerned. So those offer, according to us, also good opportunities for a long-term investor. So pharma pack can possibly keep continuing on the upward journey, but we will see separation of men from the boys, where people are more confident about long-term prospects, those getting higher valuation rather than the entire pack.
The other question, and we wrap up this conversation with that, but is on information technology, Nimesh. Again, anybody's guess, a bit of an uptick in the prices and the valuations recently, but the commentary suggests that it's still caught in a quagmire of sorts. Are you constructive? Are you negative?
I'm a bit cautious on that, and especially after the move that we have seen, maybe expectations have moved up quite a bit. We've seen guidance cuts this year by some of the major IT services companies, and in the US, all the indications are there'll be a soft landing, but a landing. It's not going to be a resurgence of growth or anything that is expected, and which is why Federal Reserve is looking to cut rates. Typically, these are good businesses, but when the clients are not doing so well because their economic growth is slow, doesn't mean that there will be a surge in spending or a good pickup in IT services business. So overall, great companies in terms of cash flows and ROEs, but I believe expectations have moved up significantly in this side of the market. Maybe we see some downgrades coming if the economy globally slows down further.
Okay. Sorry, I'm squeezing in one more, because you had mentioned that you look at both ends of the crowd behavior or the popular, unpopular thing. What was popular, ranked popular in 2023 was PSUs, right? Nimesh, I'm trying to understand. You can't brush, I mean, we can't brush the whole pack with the same brush, I know, but, or the same color. But everything moved up. Now, is there merit in select pockets in the PSU basket? Or are you cautious because typically the basket moves as a pack?
No, definitely there is merit. Again, here we'll see separation of men from the boys, where we've seen certain companies having good order books, good execution capabilities, better margins and working capital, especially with them. Those can continue to do well. However, I think there is some bit of exuberance there. There is in the space overall that people are excited to hear about stories on PSUs and then start pricing them in very quickly. So maybe a correction is due, but it's not an end of, say, the bull market for PSUs. Some of them can continue to do well. Some of the stories that we are seeing in terms of defense, in terms of renewable energies, in terms of overall power capacity in the country, those are pockets which will continue. So it's about how much has already been priced in, how many years of order books and growth has been priced in. So, and you are right, we can't paint them with the same brush.
Right.
So here we will see some kind of correction and then probably separation of men from the boys.
We'll try and talk about this in detail and the other conversations that we do, Nimesh, but lovely talking to you. Thanks for taking the time out and being with us today.
Pleasure being here. Thank you.
That's the wrap on Talking Point. Viewers, thanks so much for tuning in.
Hello and welcome. This is Agam Vakil. You're watching the FNO show, and in this show we take you through all that is happening in the futures and options space in the derivatives markets in India. Well, at the moment, what we're looking at is a little bit of weakness as far as benchmarks are concerned. Not too much to speak for otherwise. There has been a little bit of a drop starting off from early on in the sessions, and from there on, we have seen we're looking at a little bit of recovery from the day's lows. In fact, both the Nifty as well as the Bank Nifty are off day's lows as we speak. The question really is where do we go from here at the moment, considering the Bank Nifty is looking at a decline of about 0.3%, and the Bank Nifty, and the Nifty as well is down just by around 0.5%. In terms of some of your bigger movers as far as your key indices go, we are not looking at too much going on out here. Something like in terms of at least of the constituents, we are keeping an eye on a handful of names, especially when it comes to the benchmarks, and that's where we will keep an eye on what's in fact going to drive the markets. Do remember that when it comes to the benchmarks, what's giving a little bit of support at the moment is the Adani Group companies, Adani Enterprises and Adani Ports, along with ITC, which is providing a little bit of support. Of course, on the losing end, we do have a lot of weakness coming in on account of Infosys, HDFC Bank, as well as TCS. This as far as your benchmarks are concerned. Even in terms of the big movers, that is losers and gainers, you have the likes of Bandhan Bank, which is up around 5% in the broader markets. We have something like an L&T Finance as well, which is also up and about for now, up around 3.5%. And Trident is also the other one, which is up around 3%. And on the losing end, we aren't talking about too much. We do have some amount of pressure on BHEL, that's Bharat Heavy Electronics. That's down around 3.3%, and Emphasis is down around 3.1% as well. Coforge under a bit of pressure as well. Do remember, we are going to get into the earnings season very soon. We're not expecting too much with respect to the IT pack in general, of course, being a seasonal one on account of large furloughs coming through. That said, we're going to continue to keep an eye on the information technology companies. And to very quickly take a look at what's happening in the futures and options space as well. Let's pull up the snapshots for futures, index futures, as well as your others. So as far as your Nifty futures go, we haven't seen too much change in your open interest, even though the underlying has declined by around 0.5%. As far as the Bank Nifty is concerned, let's pull that up. That one be a little more important today. We're seeing unwinding to the tune of nearly 3% decline in open interest, and even as that particular index is down by around 0.25%. Of course, it is in fact what it's doing right now is that we're seeing a little bit of recovery from day's lows. So that's something that we will need to keep an eye on as far as that particular index goes. Moving on in terms of the options, segment as well, we are looking at, for the Nifty at least, a little more writing around 21,700, 21,800 calls, and on the lower end, we're seeing a little more resistance building up around 21,400, 21,500. These levels will be important, especially given the Nifty and where it is, and of course the Bank Nifty. That's the weekly options expiry today, currently trending slightly higher than 47,600. So keep an eye on that one as well. And we continue to keep watch out for the options expiry as we move into trade today. On that note, let's get in the experts for today. We have Richard Jain, CMT and lead research analyst at 5paise, and Ajit Mishra. He is the Senior VP at Research or Religare Broking. Gentlemen, good morning and thank you so much for joining in. Ajit, I'll start with you. Your view on the Nifty specifically. How would you trade this on an intraday basis or perhaps a positional view? What's the sense here?
Yeah, good morning, Agam. So, Agam, it's been like 3-4 days of consolidation. The last trading session, it was more of a banking in the